All right. Hello, everyone. Welcome to the Retire Ready podcast. I'm David Nicholas here with Aaron Jones, our CPA and financial planner, the tax man.
It's time to talk about taxes, David.
Yeah.
You know what time it is.
You've probably been called worse than the tax man, right?
There's been much worse.
Okay.
Much worse.
Just making sure. Today we're going to talk about taxes. It's going to be great. So I want to bring in Aaron Jones again, who's been such a great addition to the podcast, but he is a CPA. He's also a financial planner here at the firm. We're early in the year. Many of you are doing your tax returns probably around now and going through all that. Well, I guess you can file an extension, which I've done for many years because
that's fair.
Which many business owners do. But this is tax season, so we want to talk through some of that. You can always go out to our website, which is retirereadyplan.com. Lots of great info. The podcast episodes for prior podcasts are there. You can go to YouTube and find past episodes of the show as well. So, all right, AJ, let's talk about taxes. So we're going to try to make this enjoyable and not painful for 30 minutes.
It's not easy to do with taxes, but I think we're going to make it happen today.
Yeah, that's right. I was going to say, man, you might want to move your mic just to where you can point it down. There you go. I forgot to tell you that before.
A little tall?
Yeah, a little tall for you there.
Sorry for us shorter folks.
Hey, Aaron, stand up next time.
There we go.
So, okay, let's think about 2024. So what are some of the things that we should be considering? Here we are early in the year for individuals this year when it comes to taxes.
Mm-hmm. Yeah, well, many of you are probably getting ready to file your taxes right now, and you're looking at maybe the hopeful return or refund you may have gotten, but for those unfortunate few, the big tax bill you have to pay now, right? And so many of you are wondering, okay, what are we going to do this year, to help our taxes next year, right? And so I want to talk about a few of those options today, David, okay? First one I'd like to talk about is consider where you're investing for retirement. Okay. So many of you probably here that are working have a company plan option, 401ks, 403bs, 401as, many options that are out there, right? Consider investing up to your match, right? David, tell me, why is that match so important there?
Well, it's free money.
It's free money.
Yeah, if you're not doing the match, you're leaving free money on the table.
Yeah, many of you probably get at least a 3% match, and so if you invest up 3%, that's 100% return on your money. Mm-hmm. David, can you guarantee our clients 100% return in the stock market?
No.
I'd love to. Love to, right? Yeah. But the odds are probably not going to happen.
No, we can't. Exactly. Right. And I mean, even I get the question, David, should I put more than my match in? Yeah, I think you should be putting in a minimum 10% of your salary. I would say tie 10%, but the next 10% should be going at a minimum to your retirement account as far as saving for retirement.
Absolutely. And the other thing we want to consider is tax-free income in retirement. Tax-free income is very important. Okay, so invest up to the match. I would say that's step one for planning in this retirement stage, where my money is going in retirement. Option 2 after that, though, is consider where we can get tax-free income. Does your company offer a Roth option? There are Roth 401ks, there are Roth 403bs, and as of December 2022, there are now Roth SEP IRAs for anybody individually operating a business as a business owner there as well. And so consider that. If for Roth 401ks, consider moving your contributions there. You don't get that tax deduction anymore. I know that tax deduction is pretty attractive, David. However, all of your earnings and contributions in retirement can be accessed tax-free. There's also no required distributions on those dollars, so you can also access your money just when you want to. You're not forced to take it out ever.
Yeah, this is that seed versus harvest analogy.
Love that analogy. Go ahead.
So, again, I don't really care what tax bracket you're in. I'm in a higher tax bracket, like many those that are working, and if you have two income households, it could be in a very high tax bracket. Mm-hmm. I still 100% of my retirement money goes into a Roth IRA. Mm-hmm. Like you said, well, David, you missed the tax deduction. Don't you want to go into a pre-tax account to get a deduction? No, that is to me a racket, with all due respect to the federal government, because sure, they'll give you that tax deduction today and you feel good about it. You pay lower taxes today. But then when you go to take that money out in retirement, if it's in a pre-tax account like a 401k or an IRA, you have to pay tax on that. So for your Roth contributions, again, every situation is different. You should consider your own situation. But even if you're in a high tax bracket and you put money into an IRA, into a Roth IRA, you pay tax on the seed, but when you go to pull out in retirement, if you put in $5,000 today, $10,000 today, $20,000 this year, next year, the following year, that grows to $1 million in retirement. That all comes out tax-free, and that's the route that I think we should take.
Absolutely. And one of the great kickers there, David, is also around the taxes around Social Security. So one, I hate Social Security could even be taxed when you receive it anyways.
Literally, it's our money we put into Social Security.
Exactly.
They take it out of our paycheck by force, and then they give it back to us.
Yep.
and then they tax us on it.
And the tax on it, right? But here's the nice
It's
thing.
insane.
Okay. Social Security is taxed based on something called your provisional income, right? It's a very complicated setup here, but it basically is certain tiers. It's structured under certain tiers. Okay. Once your provisional income, which is half of your Social Security benefit plus all of your other income, pensions, IRA withdrawals, interest that you earn in your savings account at the bank, all that's under your provisional
So
income.
say your Social Security income is $30,000 a year. You take half of that, $15,000, and then add in all of your other income.
Everything
so
else that you've earned.
pensions.
Yep, all of that. Once that reaches certain tiers, more of your Social Security starts being taxed. Okay, and so now here's the nice thing: no more than 85% of your Social Security will ever be taxed in any one year. However, if the only income you're generating is from a Roth IRA, which, as we talked about, is completely tax-free, well, then guess what? Your provisional income is only half of your Social Security benefit, which is non-taxable. So if the only income you're generating, David, is from Social Security and a Roth IRA, Roth 401k, and retirement, you have no taxable income. Now, you never pay another dollar in taxes.
Yep. I've got those brackets here for the provisional income, just so our readers will know. And I know you know this, but just to get the exact.
Yeah, go ahead.
Oh, I just had it here. So from 0 to
33, 32.
Yeah, so from 0 to 25,000, there's no taxes on your
No
Social
taxes at all.
Security.
That's right.
And then from 32 to 44,000, from let me make sure I get this right. Sorry,
It's
I
up to
thought I
about
had it up
50.
here. That's right. So, gosh, single versus I had it up and then I got it off the screen. So, okay, here we go. So, up to 50% of your taxable benefit, right? So less than 25,000, no income tax for single filers. Then if you go from a combined income of 25 to 34,000, 50% of your Social Security benefit becomes taxable. If your combined income is more than 34,000, up to 85% of your Social Security will be benefit. That's single. For married couples, here's the number: 50% starting at 32,000. So anything below 32,000, no income tax. If your provisional income is between 32 and 44, that's 50%. 44 above. So if your total combined income is $44,000 or more per year, 85% of your Social Security benefit will be taxable. But I think many of us may forget that if your income, like Aaron was just saying, is $100,000 a year in retirement, but all of that $100,000 is coming out of your Roth IRA, in the eyes of Social Security, because it's coming from a Roth, it's zero.
Right.
So you would pay no income taxes on your Social Security benefit. If that $100,000 is coming out of an IRA or a 401k, all of your 85% of your benefit, you'll be taxed the maximum amount for Social Security. So it's thinking through some of this, where you could have none of your Social Security benefits taxable or 85% of them, just depending on where the source of income is. So it's pretty important. Roth versus non-Roth.
Spot on, David. So even if you are in a relatively high income tax bracket, again, make sure it makes sense for your financial situation, but consider investing into those tax-free buckets: Roth IRAs, Roth 401ks, 403bs with your employer as well. David, one other thing I like to mention is generational planning.
Okay.
Right? In terms of investing in the future of our kids. Okay, and David, you know I've talked about before. I know you've started some of the education funds for your children, as well as custodial Roth IRAs. Talk to me a little bit about those. You got 529 plans set up, right?
I do, and this is something where I should take that back. Two out of three of my kids have 529 plans.
Who got the short stick?
Poor Luke,
Who got the short
my
stick?
3-year-old son. I just forgot to set it up. This is this is not great coming from your financial advisor. But my girls, the minute they were born, so excited, went to set up their 529s. And then it's the classic third child. His room wasn't even ready till he was probably 2. Much less he's not even going to be able to go to college now. So I've got to go back and make up for Luke. But it's so easy. I think it's Pathway to College.
Path2college.com. For the state of Georgia, path2college.com. Great 529 plan.
Yeah, so for our Georgia listeners, I think Georgia 529 plan is fantastic. Okay. But I put it in every month. It's on autopilot. I put it in the most aggressive thing that I can because they're young right now. They got 15, 16 years to go before they'll probably need this money. So that's the first thing. That anyone can do. Also, it's great for grandparents.
It is.
So for our clients that are grandparents, that you may have young grandkids, and you're figuring out how do I help them, 529 can be a great thing. You can set it up in your grandchild's name. Anyone can contribute. Or let's just say you're the middle generation and you want to set up an account for your kids, your parents can contribute to that as long as they have that 529 account number. So it's really great and easy to use. Now, where we get into some more advanced planning.
Yeah.
This is where, can you start retirement accounts for your kids when they're under the age of 18? The answer to that is yes, you can.
Yep, you absolutely
now,
can.
What are the rules around that? Well, the rules are they have to have income.
Yep.
So if your kids under the age of 18 have earned income, they can contribute to a Roth IRA.
That's right.
So my kids do have earned income. And kids, how do kids get earned income? They could get it in a lot of varieties. If your kids do any type of modeling, if they do any type of photography that they get money for, which is for what most kids can do, usually being young, that money, if it's earned income, it can go right into the Roth IRA. So for our kids, any income that they get from any type of modeling or photography, we take that income and I put it right into the Roth IRA for them. One, they don't pay tax on the income as long as it's under certain thresholds. I think it's around $14,000 a year. There's an income limit there. But two, when they go to be in retirement around age 60 or 59 and a half, they have access to that money and it all comes out tax-free. So they didn't pay any tax when they received the income. Then they put it into a Roth IRA and it all comes out tax-free. So it's one of the most amazing things you can do, but your kids have to have some type of earned income. Let's just say you own a business. David, can I employ my kids in the business? Well, what kind of business are you? I'm a doctor. Well, unless you're 13-year-old's going to be doing surgeries, it's going to be hard to justify that. Well, David, my daughter is 16 and she interned for the summer at the front desk and she earned income. Could she put money in a Roth IRA? Absolutely. If she was actually doing work and she was actually earning income, that would qualify to be able to put money into a Roth IRA. So as long as they have actual work where they're getting actual income, you can put money in a Roth. And I think that's one of the most fantastic wealth building tools to start them early at such a young age.
It's a great provision to add for family planning, for retirement planning, for your kids to provide a really big benefit for them in retirement. Spot on, David.
Yeah.
The last one I want to consider for all of our clients, listeners that may be still working right now, is HSA accounts, health savings accounts. Not everyone will apply for these. You do have to have a high deductible healthcare plan to be eligible for this type of account. But if you are, this is one of the only accounts that actually has a triple tax savings associated with it. You get a tax deduction for your contributions, your earnings grow tax-free, and as long as they're used for healthcare, everything that you put in can be accessed tax-free. Right? Really powerful provision here. You got limits on them. Single filers, $4,150. If you are eligible for this type of account. Married filing jointly, $8,300. And so I do like to add that note. Again, one of the only types of accounts that can grow in that three ways: tax deduction for all your contributions and tax-free earnings in retirement.
Yeah, the HSA really is, it can act like another retirement account.
It can.
Because you put money in, you get a tax deduction. And if you take it out, say you don't need it for health expenses in retirement, it then becomes like an IRA account. You pay taxes at the withdrawals.
Exactly.
The only way you get to pull money out of your HSA tax-free is if you use it for medical expenses, and those are defined. But even if you don't, if you have perfect health and you retire and you have this HSA account that's 40, 50, 60, 100 grand, then you can pull that out in retirement. And you got the tax deduction though along the way.
Exactly. So that covers for our listeners who are still working right now. But what if you're retired? Well, you typically don't have much earned income anymore, if at all, right? There's no real opportunity to continue to put money away towards retirement. And so what are a few things there? Well, remember, RMDs was required minimum distributions for all of your pre-tax accounts. That'll begin at age 73. So whether you get your birthdays on January 1 or December 31st, if you turn 73 this year, please keep in mind you do have a required minimum distribution this year. You can defer this first year only to April 15th the following year. So if you turn 73 December 31st and you're like, I don't want to take it this year, let me wait till April next year, you can defer, but then you are responsible for taking 2 distributions next year. And so not everyone will make sense for that situation, but if you have a big income this year because you sold a property, you had a big expense, you had to take money out of your IRAs and wanted to delay, then you could delay that until next year as well. David, one of my favorite provisions of the tax code, and we've talked about it before, qualified charitable distributions.
Yeah, this is one that I feel like most people, if you're not retirement age, you almost definitely don't know about it. But even for those of our clients that are 70 and older, many of them haven't heard about what's called a qualified charitable distribution. So I think this one is one that if you're not doing it, you're simply just leaving money on the table for sure.
I don't love many tax laws out there.
Yeah.
Right. Most of them, you're taking money away from American people. They're hard-earned dollars. And again, I'm okay paying our fair share in taxes, but I don't pay $1 more than I have to. Okay. Dave, you and I have talked about it. You and I are both charitably inclined. We give to our church. We give to our community. So if you are 70 and a half or older, if you take money directly out of your IRA and don't come to your bank account, don't send it to your personal account, send it directly to a qualified 501c3 organization. Most churches and charities do qualify for that, but it is important to check. Those contributions go out completely tax-free. And here's a nice thing. If you're in required distribution age, it also satisfies that amount of your required distribution. So let's say, David, let's imagine you had a $1 million IRA still and you had to take out $50,000 this year. But you had already planned to give $20,000 this year. Well, then great. You can take $20,000 out of your IRA. It goes directly to your favorite church, charity, nonprofit of your choice. Goes out completely tax-free, and now you're only required to recognize income on $30,000.
Yep. Yeah. So it's above the line deduction, which
Exactly.
is interesting. The trick, though, is you just can't take money out of your IRA and send it to your nonprofit. The money has to go directly from your IRA. Exactly. It doesn't come to you. It generally will go. The check can come to you, but it's made out directly to your church, nonprofit, synagogue. It has to be a 501c3.
Yep.
David, my daughter really cares about the homeless. I'm going to give her some money that she can help out here in Atlanta. Mm-hmm. Does that count for my qualified charitable distribution? Unless she has a 501c3 organization that's an official nonprofit, then no, it would not count. It's got to go directly to 501c3s, churches, nonprofits, synagogues. But the trick is the custodian. So if your money's at Charles Schwab, if it's at Fidelity, the check will actually go right from Charles Schwab and be sent directly to the nonprofit. And then you've made your deduction, you made your contribution, and now that could satisfy your RMDs. And I had a conversation with my mom the other day about this because she ties faithfully to her church. She's of RMD age. And I said, Mom, I was like, how much we talked about her RMD requirements and what she was giving to church. I was like, Mom, you could just give your RMD essentially, mm-hmm. and it would take care of your contributions for church. And then you wouldn't have to worry about any additional taxes from RMDs and then just to get the deduction. And she was like, I'm her son, a financial advisor. She's like, why have I not heard about this? And I was like,
mm-hmm.
well, but Mom, I've talked about this before. But she was like, no, that sounds great. Let's do it.
Awesome.
So it's something that I think if you're not doing, again, that could save just on the qualified charitable distributions, easily a few $1,000s in above the line deductions just by writing it that way versus writing the check after the fact.
That's right. And many people right now, if you are giving right now, probably aren't receiving a tax benefit for those contributions.
Oh, because the standard deduction.
Because standard deduction is so high. I find many people right now are just taking the standard and not even itemizing. So again, I know we don't give mainly for the tax benefit. We give to bless our community, bless our churches, bless our synagogues, bless our community. But if we can get a tax benefit by giving, I think we should do so.
Because imagine the standard deduction for a couple right now is what?
If you're under 65, it's $29,200 for 2024.
So over 65, you're what, 30?
Over what, 30,700, I believe? Right over 30,000.
So the standard deduction, if you give $10,000 to your church,
mm-hmm.
you don't get any benefit for it. There's no tax benefit.
None.
Which again, like you said, we don't give for the tax benefit, but it was nice to give and also get the tax benefit. So because under the Trump tax laws, the standard deduction went so high,
mm-hmm.
you could give 10, 15, 20, 30,000 even and may not get a deduction for it. But if you give it as a qualified charitable distribution,
mm-hmm.
you still get that full standard deduction, but then you don't pay tax on the required distribution. Or if it's eligible for those 70 and a half.
7 and a half, correct.
So even if you're not at RMD age yet, which is 73, even if you just turned 70 and a half, you now qualify for that charitable distribution. Let's just say you gave $5,000 to your church every year. You could still get the full standard deduction, and you'd get $5,000 in RMD withdrawals or just IRA withdrawals with no income tax, and that would be completely tax-free. So it just if you're in a 20% bracket, $5,000 deposit, that could be $1,000 in tax savings, roughly, the way the math would work out.
Power provision in our tax code right now.
Yeah.
Power provision.
Yeah.
The last strategy I want to consider, and this isn't really a short-term tax saving strategy. And David, some of you and I talked about a lot the last few years, are Roth conversions.
Yeah.
Okay. David, tell me a little bit about why would I think about paying taxes now?
Yeah. Well, again, 2025, what are we? We're in 2024. So we have 2024 tax year, 2025 tax year. We have an election this year in November, which, again, there's a lot that's at stake as far as tax policy, just legislative policy. And so the current tax rates, probably sound like a broken record here, but the current tax rates were not permanent that were passed in 2017 under President Trump. They expire in 2025. Hard to believe.
Yeah.
I remember that tax bill was passed in 2017. That was almost 6 years ago. So in the 7th year, which is next year, is that right? 2017 plus, or is it 8 years? I can't do my math this morning. But that bill will expire. And if nothing is done, it'll sunset to where taxes were pre-2017.
Exactly.
So we know the odds are that taxes are going higher. When you add in our national debt, we've done podcasts on our national debt. You can go back and listen to. We have I can't even keep up, $35 trillion in debt. That number will be over $40 trillion in the next few years. Our budgets are exploding. We're spending on military. We're spending on Social Security, Medicare, Medicaid. It's the amount of money that is going out of our federal government. It is hard to fathom. And so when we look at all this, and we know that Washington has a very hard time cutting spending, where are they going to get additional revenue from? Well, in my opinion, they're going to get additional revenue by not cutting spending. They're going to get additional revenue by raising taxes. Now, you may say, well, David, thankfully, I'm just a humble middle-class American. I work hard. I make a decent income. And, I try to provide for my family. They're going to go after the wealthy, the top 1%ers to get this tax revenue from. I'm safe. But here's what I want you to put this in perspective. Even if they just confiscate the wealth of the top 1%, that's maybe $2 trillion. I mean, if you just not even raise their taxes, if you just take the wealth of Elon Musk, Jeff Bezos, put them all in, Mark Zuckerberg for Facebook, Meta, if you just confiscate their wealth, that'll run the government for about 6 months. Yeah. No, not even that, 2.5 months, the rate that we're spending.
Yep.
So where are they really going to get income revenue from, tax revenue from? It's from the middle class. If you're someone that's saved, you're 60 years old, you save $500,000 in your retirement account. If you saved $1 million in your retirement account, you've got a target on your back. That's where the IRS is going to target, because that's where the bulk of assets are. $20 trillion is sitting inside of retirement accounts right now. So we feel very strongly that taxes are going higher. So this is the time to start coming up with a plan to start converting money from an IRA to a Roth, pay the taxes now, wash your hands of it, so that in the future you potentially will be paying no income tax when in a much higher tax rate environment.
Exactly. And that's why I love Roth conversions, David. Because again, as we talked about, in those Roth IRAs, we have to meet certain requirements first, but we can always access our conversion amounts or contributions tax-free. We've already paid taxes. But once we've met those requirements, our earnings are now capable of being accessed tax-free in retirement. So again, I don't love having to pay those tax bills now, but again, we're going to have to pay taxes one day on this anyways. If we don't spend it within our lifetimes, our kids are going to have to pay taxes on this. Who knows what our kids' tax rates will be like 20 years from now, 30 years from now, right? The odds are much higher than your retirement tax rate would be. Okay?
So Aaron, let's talk about some of the negatives of Roth conversion planning, because we talk about the positives a lot and we could give you all the data behind it. But if you're someone that's, say, 63 and you have 2 years till you get on Medicare, or let's just say you're 65 or older, you're already on Medicare.
Yeah, that's a good point.
Roth conversions will impact what we call IRMA, which is the income amount calculation for Medicare.
Exactly.
How does that play into consideration if you're someone that's 63 or 65 or older? You want to do Roth conversions, you'd say, David, Aaron, great idea, but wait, am I going to end up paying a lot of tax or additional penalties on my Medicare? It's
one of the factors to consider of how much tax savings I'm actually going to get from the Roth conversion. If it's a very small break-even point, then if we are having to adjust those Medicare premiums and enter the higher Medicare bracket, it may not make sense to do Roth conversions. But I'll tell you this, based on how the Medicare income brackets are structured, if you're if you're right at the top of the 22% tax bracket, there's no adjustment to Medicare premiums.
Okay.
It's only once you start bumping really into today's world, the current 24, 28, 32, 35% brackets, where those adjustments start getting pretty dramatic.
Yeah, I'm showing 91,000 for individuals, 182,000 for married couples is where it starts to bump up. Does that sound about right?
Yeah, 22 brackets peak at about 200,000.
Okay,
so right
it's
just
higher.
under the top of the 22% bracket there.
Okay.
So you got a lot of wiggle room. You got $180,000 of income you could recognize between Social Security, pensions, retirement withdrawals, and Roth conversions.
Okay.
Before you'd bump up and adjust those Medicare brackets.
But if you have $1 million IRA and say,
Mhm.
because I've been in the conversation with you before where
Mhm.
you've recommended for clients to be a little bit more aggressive with their Roth conversions.
Mm-hmm.
If someone has $1 million IRA and you say, hey, convert $200,000 a year for the next 5 years, they're 65 years old.
Mhm.
The odds are they're going to have an increase in IRMA.
Yep.
Is that baked into the calculation when
It's
you
gotta
do the
be.
math to make sure that so you're still looking at that, yet we know it's going to be more expensive for a few years, but it's still worth some of that short-term pain for long-term gain. Is that the mindset of it?
It is, because consider this. Again, I don't love having to pay a little bit more, right? Is it a factor? Absolutely. When you bump up into that first bracket, right, your monthly Medicare premiums go up $165
Per month.
per month.
Okay, so $2,000 a year, call it.
$2,000 a year, right? Do I love the idea of paying $2,000 a year? No. But if I'm talking about converting $1 million IRA, which could very easily generate $600,000 in taxes in a 25-year period, right? Then $2,000 a year,
Even if it's
for
for
5 years, $10,000,
Yeah.
and I saved $200,000 in taxes. Is it a factor? Yes.
It's funny when you put it. So many people focus so much on that, but when you
Mhm.
put it into a comparison of $500,000 in potential tax savings,
Mm-hmm.
$10,000 of expenses today,
Right.
it's almost a no-brainer.
Yeah, because remember, it's not a permanent lock-in adjustment to those Medicare premiums.
Yep.
It's a 2-year look back every 2 years.
So after 2 years, they will look back to see what your income was, and then it'll
Exactly.
drop when your
Exactly.
income goes down in the future.
Exactly. Spot
good.
on there. Spot
good.
on. So, point being, at the end of the day, consider those Roth conversions. Consider paying the taxes now. It's got to make sense for your financial situation. Please feel free to call us and let us know. We're happy to run that analysis with you. But consider those Roth conversions, paying those taxes now to get more of that portfolio again into tax-free buckets in retirement.
That's great.
Yep.
That's great.
Well, David, let's kind of wrap up here. I just like to mention a few more things. We talked about inheritance before,
Yep.
right? For people that want to leave a legacy to their kids, their grandkids, right? They've changed those inheritance laws pretty recently, right? And then again, I think there's another reason why Roth conversions can be so impactful, because if you leave money to your kids in an IRA or 401k, they now have 10 years to fully deplete the value of that IRA.
Mhm.
So when we talk about this $1 million portfolio, right?
Yep.
$1 million IRA, let's say you had 2 kids, right? And you were left them $1 million pre-tax. Now both of them have $500,000 of income they have to hack on to their other income for the next 10
If they
years.
take that all in 1 year, they're in the highest tax bracket.
Highest tax bracket.
Yeah, 40% between state and federal.
Absolutely.
Yeah.
Absolutely. So in a Roth IRA, they still have to take it out in 10 years, but they don't pay any taxes on it, and they're not required to take anything out of it before that 10 years. So you extended the tax-free growth for them for another 10 years.
So if you inherit $500,000, and let's just say it earns 7%
Mm-hmm.
over 10 years, that 500,000 doubles to $1 million.
Yep.
So they receive 500,000 as a Roth. They let it sit in there and grow for 10 years at 7%. The 500,000 is now $1 million.
Yep.
And in the 10th year, they can pull that entire $1 million out completely tax-free.
And it's still tax-free.
Yeah, that's way better.
So again, another reason why Roth conversions will always make sense to your heirs, because you're paying the tax on their behalf. Because again, one of you is gonna have to pay taxes on this anyways, right? It's just a matter of when we want to choose to pay those taxes, whether for our lifetime or for our kids' lifetime. So be mindful of those new inheritance laws for those IRAs, 401ks, those pre-tax retirement accounts. If you are in required distribution age when your kids inherit it, they will also have to continue those required distributions before the 10 years. The odds are you'd probably want to do that anyways, but nonetheless, it would be required. You couldn't wait for the full 10 years.
Yeah, that's good.
Yeah.
It's really good.
Yeah.
Love it. Good stuff, man. Well, this is why, again, at Nicholas Wealth Management, and for those of you that listen to the Retire Ready podcast, love having AJ with us, CPA, financial planner, really cuts through a lot of the jargon, a lot of the noise. What are the areas of the tax code that you want to be focusing on? Hopefully this gives you a little bit of just simple things to look at when you're considering your year planning for taxes. Please reach out to us if you have any questions. Aaron Jones takes calls, and he is here to help any way that he can to review your taxes and to see some areas that we can do to help mitigate or even eliminate your taxes in retirement. So AJ, glad you were here again, man. Another great week.
Been a pleasure, David.
Retire Ready. I have a feeling you're going to be back for the next show.
Hope so. Looking forward to it.
So awesome. Have a wonderful week. You can check out retirereadyplan.com for more episodes and to hear past and future updates for the show as well. Have a great week. We'll see you here next time for Retire Ready.